The strategy that builds wealth on £30,000 a year will actively hold you back on 70. And the strategy that works at 70,000 is basically impossible at 30. That's why most money advice doesn't land. It's written for someone else's pay slip. So here's what we're doing. 3 income levels: £30,000, £50,000 and £70,000 a year. At 30, the game is defense and foundations. At 50, it's automation. And at 70, it's tax efficiency, because at that level, your biggest expense isn't your rent anymore. It's HMRC. By the end, you'll know exactly which moves match your salary in the right order, with UK products all the way through. Let's go. Just a quick reminder. Nothing in this video is financial advice, it's purely for educational purposes, and you should always do your own research before making any financial decisions. £30,000 a year in the UK gives you roughly £2,080 a month after tax. Honestly, that's tight. Rent, food, transport bills. There's not much left over. And that's exactly why every single pound has to have a job. The first job is killing expensive debt. According to the Money Charity, the average credit card debt per UK adult is around £1,250. At an average APR of about 19%, carrying that balance for a year costs you roughly £125 in pure interest. When your take-home is £2,000 a month, that's not a rounding error. That's the difference between building savings and treading water. And here's the modern trap. Buy now, pay later. Klarna, ClearPay, all of it. It doesn't feel like debt because there's no interest. But stack 3 or 4 of those easy payments, and you've committed hundreds of pounds of future income before the month even starts. That is debt. Write down every balance you owe, pick the one with the highest interest rate, and attack it first. While you're doing that, do not skip your workplace pension match. If your employer matches your contributions, that is an instant 100% return on your money. There is no investment on earth that guarantees you 100%. It's free money, it's taken before you ever see it, and opting out to free up cash is one of the most expensive decisions a UK worker can make. Then a starter emergency fund. Forget 6 months for now. At this income, aim for 1 month of expenses in an easy access savings account, around £2,000. That's enough that a car repair or a broken boiler doesn't go straight onto a credit card and undo everything you've built. One last thing, at this level, £30,000 a year across 2,000 working hours means your time is worth about £15 an hour. So before you spend every weekend doing deliveries for 12 quid an hour, think bigger. A certification, a course, a skill that moves you from 30 to 35 or 40 permanently. That's worth more than years of side hustles. At £50,000 a year, you're taking home around £3,300 a month, and this is where most people quietly go wrong. Not because they're reckless, because they're manual. Here's the fix, and it's the single most powerful system in personal finance. Pay yourself first, automatically. The day your salary lands, a standing order moves your savings out before you can touch them. Into a stocks and shares ISA. Into low-cost index funds, done before breakfast. If you rely on willpower and whatever's left at the end of the month, the system breaks. 1 month you're tired, 1 month it's someone's birthday, 1 month it's just gone. Automation doesn't have bad months. How much? Aim for 15% of your take-home, around £500 a month at this level. If you're currently saving 3%, don't jump straight there. Start at 10. Consistency beats intensity. Same as personal fitness training. You don't max out on day one. You show up every week and add a little more. Marginal gains, compounding on themselves. And the reason this matters so much, £500 a month invested from age 30 at 7% average returns is over £800,000 by 65. That's from about 200 grand of your own contributions. The market does the rest. Now, the question that changes everything at 50k, stop asking, am I okay this month? And start asking, when am I actually done? Take what you spend in a year and multiply it by 25. That's your financial independence number. It comes from the 4% rule. Spend £24,000 a year, your number is £600,000. And here's the mad bit. The date you hit it depends on your savings rate, not your salary. Save 20% of your income and you're looking at roughly 37 working years. 30%, about 28 years. 50%, 17, because a higher savings rate means you're spending less. So your finish line moves closer at the same time as you're running faster. Work out your number. Write it down. Every money decision gets easier once you know what you're actually aiming at. One warning before we move up a level. Lifestyle inflation. 50,000 a year spent like 50,000 leaves you exactly as wealthy as the person on 30 who spends 30. The payslip changed. The outcome didn't. £70,000 a year. And here's what nobody tells you at this level. Your biggest expense isn't your mortgage, it's tax. Everything you earn above £50,270 is taxed at 40%, plus national insurance. So on a 70k salary, nearly £20,000 of your income is sitting in the higher rate band getting hammered. Which makes this the most valuable move in UK personal finance for higher earners. Salary sacrifice into your pension. Every pound you sacrifice from that higher rate band goes into your pension pot, instead of arriving in your bank account as 58 pence. You're getting an instant uplift of over 40% before the money is even invested. Next, actually use your ISA allowance. £20,000 a year every year, where all growth and all withdrawals are completely tax-free. No capital gains, no dividend tax, nothing to report to the government. At this income, you can genuinely start filling meaningful chunks of it. And if you're under 40 and saving for a first home, the Lifetime ISA gets you a 25% government bonus on up to £4,000 a year. A free £1,000 annually just for using the right account. And one silent killer to check. Investment fees. Say you've built £100,000 and it grows at 7% for 30 years. With near zero fees in index funds, that becomes about £760,000. Hand it to an advisor or a fund charging 1% a year and it becomes about £570,000. That tiny 1% quietly took £186,000 of your compounding. Check your platform, check your funds. Low-cost index funds on platforms like Vanguard, InvestEngine or Trading 212 charge a fraction of a percent for the same market. At 70k, defense built the base and automation built the engine. This level is about protecting the compounding from tax and from fees. That's how the same salary produces two completely different futures. So wherever you are, 30, 50, 70, the playbook is the same shape. Kill the expensive debt, take every bit of free money, automate before you can interfere, then defend your gains from tax and fees as the numbers grow. The income changes the tactics. The discipline never changes. And honestly, that's the whole edge. Most people wait until they earn more to get serious. Athletes don't wait for match day to start training. If this gave you any clarity at all, share it with one person who this might help too. I'll see you all in the next one.